introduction. So first I want to say, Sydney, thank you so much for having us here today. I mean, it's a great honor to be able to speak at one of your events, and really excited to be here. We're going to talk a little bit more about the evolution of the industry, and really most importantly, finally, we're at a point where we could talk about the catalyst that is going to make this baby scale. So, you know, the industry has really come a long way in the last couple of years, even though it's still really young. We finally have Reg A Plus that has been in effect for now almost a year. We have the majority of states that have adopted their own intrastate crowdfunding legislation. We have Title III, obviously imminent. We have legislation being introduced that's going to broaden the accredited investor definition. We've seen a lot of volatility and underperformance in conventional fixed income class and in conventional asset classes. And with that, we've seen a growing demand for alternative asset classes, particularly in private credit. And, you know, we've seen a tremendous amount of financial innovation and really exciting tools and resources happening in the fintech space. So with all of these factors kind of coming together, now is the point where we could really talk about making sense of all of them and how we can get this industry to scale. So, okay, sorry. So for the last 6 years, I've been, as I said in the earlier panel, an unrelenting advocate of crowdfinance. And really what draws me most to this industry is my fascination with evolution and progression and how specific events lead us into uncharted destinations. What causes things to evolve? What causes things to change? And ever since I began my career on Wall Street 24 years ago, I've been in search of these catalysts. So, do you want me to stand over here? Okay. So when I first started off as a financial advisor, I fell in love with trading. And I was always looking for that catalyst that would make a stock rise or fall. Then I became obsessed with looking for the catalyst that would predict market trends or industry trends, the catalyst that will fuel an industry. Then fast forward a number of years later, in 2009, I was a mom to two little toddlers, and I found a new obsession, and that was social media. And I was having a blast reconnecting with friends on Facebook. And that's really where my journey, I think, into this part of the industry really began. I reconnected on Facebook with an old coworker of mine from my Wall Street days, a woman by the name of Lisa Thompson, who was one of the first internet analysts on Wall Street. And she reached out to me and said, Dara, what do you make of these emerging venture exchanges that are you know, developing shares posts and second market that we're developing to facilitate trades in private companies like Facebook and Twitter? And I started looking at it and I said, you know, this is really fascinating. And I started seeing some really interesting parallels between the emergence of NASDAQ and what was happening now. And I just became completely inspired. It lit a fire under me. And, you know, what I started doing was I just wanted to really go back and look at everything about our markets, do extensive research on the history of the markets, what made our markets so great, what made the U.S. capital markets the envy of the world, you know, what fueled stock market growth and economic prosperity? Was there a catalyst that we could pinpoint? So I came up with this hypothesis that it is actually there was, and for the at least last century, it's been an invention in mass communications that's been the impetus for stock market growth and economic prosperity. And if you look at it, the radio inspired the bull market in the 1920s, television, the next bull market, 47 to 57, the internet in the 1990s. And if you really look at what was happening here, each one of these new communications mediums was creating a more dynamic and meaningful way for brands to engage consumers. And, you know, ultimately, when consumers are engaged and they're buying, stocks are rising and economies are growing. And that was kind of the gist of the hypothesis. And, you know, as someone who is now, you know, obsessed with Facebook and social media, and I was realizing, you know, I wasn't getting my ideas to buy products anymore from a radio jingle or, a television commercial. We're all, fasting forward and, not even watching commercials anymore. And I certainly wasn't clicking on banner ads. But where I was getting my ideas for products was from my friends on Facebook. And I said, social media is a game changer. And it is more powerful than the radio, television, and internet combined. And it really, I believed, so powerful that it really did have the ability to be, to really usher us into a whole new period of prosperity. But unfortunately, unlike the radio, television, and internet 1.0, social media arrived at a time, it was after, pretty much when it was really starting to rise, after the 2008 meltdown. No longer were banks lending and our small cap IPO market was pretty much decimated. So, whereas you had the radio, the television, and internet 1.0, we had these functional capital markets that enabled the people's capital to capitalize the innovation of the day. We didn't have that anymore. Then I started looking into other kind of catalysts as well. What causes crashes, and that, you could read these after. I'm going to go a little bit faster. Next one. What causes bubbles, and I started really becoming fascinated by this, what was happening here? Is this some kind of a revolution, or is this just another a tech bubble? And then I realized, no, we are in a revolution. And I started blogging about this and just what I was feeling, what I was seeing. And I started writing about, problems with our IPO markets, the effects of social media, these emerging private markets, bubbles. And then I started taking the blog on the road. And it was really just having these events to, like this, really interactive to discuss this phenomenon that was happening in financial services. And then I started tracking some of the legislation that was happening. And this is now, 2011. So this is pre-Jobs Act. And in the fall of 2011, a bundle of bills had just passed the House Financial Services Committee that we now all know as the Jobs Act. But at the time, the crowdfund bill was one of the bills that was bundled into that package. And I was just fascinated by the crowdfund bill. I said, this is going to be a game changer. And, really took everything that we knew about securities legislation and just really tossed it out the window. I was fascinated by it. I wrote an article called Bipartisanship Prevails for Job Creation. And in it, I talk about how crowdfunding could be, something that will really level the investment playing field. And I sent the article to Congressman McHenry, who introduced the bill. And he liked the article, graciously agreed to headline an event that I was doing in January 2012, which actually became the first crowdfunding conference of the country. And you could tell at that event that there was a lot of energy in the room. Something exciting was happening. It was standing room only from the first presentation to the last piece of broccoli was eaten off the crudité at the cocktail party. I mean, people were really excited about this. And, and you knew that this phenomenon had the power to become a movement. But it was a movement really more of like fascination. What does this mean? It wasn't one of action. And around this time, I'm connecting with all new people on LinkedIn, and I get a LinkedIn request from this guy who's a self-directed IRA expert named Jim Jones. And Jim says, let's, we should really talk. So Jim and I, we schedule a call, and Jim calls me up and says, there are trillions of dollars that are sitting there in retirement accounts that could capitalize this industry. And, I'm thinking, yeah, but I don't think that, traditional retirement plans are going to accept these kind of products. And Jim says, yes, but self-directed IRAs can. And, the more Jim spoke, the more I became fascinated with this whole process. And I said to Jim, you've got to speak at my events. You've got to get this message out there. So Jim really opened my eyes and made me realize that one day, it would be the self-directed IRA that would help enable crowd finance to scale. So with everything in life, we need to progress to get to, the point where we're at. So in order to understand the catalyst that is going to enable crowdfinance to scale, I thought let's just talk a little bit about we need to recognize and appreciate the catalyst that inspired crowdfinance, that birthed it, and that fueled it. So here's social media, as we talked about before. Oh, it's working now, good. I believe is the catalyst that really inspired crowdfinance. Social media has just been causing communications to advance at warp speeds. So to put it into perspective, okay, it took 38 years for the radio to reach 50 million users. It took 13 years for the television to reach 50 million users. It took Cityville, that stupid little Farmville social media game, 21 days to reach 50 million users. It's just incredible what was happening. And I was just started to think, this is just not a bubble, this is a revolution. And I think the same thing could really be said for fintech, because, and even as Mark Broderick said in the panel earlier today, what really is happening here? It's really just, it's the internet infiltrating finance. It's social media infiltrating finance. But in this case, the product is the investment. It's an equity stake in a business, or it's a note. So that said, I know there's a lot of people looking at what's happening with publicly traded fintech stocks now and saying, "Oh no, is this the end? Is this, is the bubble bursting? Is it 2000?" No, I don't think so at all. I think that what's happening here, despite the recent decline in stocks, I think that we are still in the early stages of a financial revolution. Everything is changing. I think just what's happening here is that the industry is waking up finally and realizing that in order to really grow, it needs to scale. And I think, these little kind of bubble bursts in the midst of these financial revolutions are a good thing, because it's a time when the marketplace could really expunge a lot of the garbage, and it could clear the way for the real solid businesses to emerge and for innovation to blossom. So now that leads me to the catalysts that birthed crowdfinance, and I point to two significant events. One is the Facebook stock buying frenzy. Now, I don't know if you guys remember this, but before Facebook actually went public, people were like killing each other for Facebook shares, literally. I mean, it was crazy. And that really is great. This was the catalyst right here when Lou Kerner, who's Wall Street's first social media analyst, wrote a report on Facebook, basically pegging it as a $100 billion company. At the time, it was valued at around 15 billion. And with that, I mean, it just sent, people went crazy for it. And, people were clamoring to buy shares of Facebook on Shares Post and Second Market. And it created a whole subculture of brokers that were trying to get in on the action. It caused legislators to start to introduce new bills, raising shareholder thresholds that allowed companies to stay private longer. But I think most importantly, what the Facebook frenzy did was it underscored some real serious flaws in our U.S. equity markets. It brought to surface two significant factors. One, how expensive and burdensome it is for small emerging companies to actually go public, and how unjust and dysfunctional our equity markets have really become. And what was happening here with these companies delaying their IPOs, all of the appreciation was being realized by venture capitalists and PE funds, as opposed to where it should be, or where it had been prior to this, was in the retirement portfolios of ordinary Americans. And the second catalyst, I think, was really what was the emergence of Prosper and Lending Club and what they were doing on the debt side. What started out was really just a way to use the internet to match borrowers and lenders. It escalated into an entire transformation of global credit markets. I mean, Foundation Capital predicts that by 2025, $1 trillion in loans are going to be originated online. So now we get to the point, what is the catalyst that really fuels crowdfinance? Now, I believe if you peel the layers and you get to the core, I think that the catalyst that really fuels this is the desire for economic equality. And, if you look at this, we saw this over the last couple of years, 2011, the Occupy Wall Street movement, the Tea Party movement, uprisings in Egypt. And we're seeing this now even in our election cycle. I mean, this is unprecedented. It's people crying out for economic freedom and economic parity. And it's not hard to know why. I mean, look at this. This is the last 100 years of a chart of wealth inequality in the U.S., okay, the last century. And what we find most striking about this chart is when the wealth disparity in this country started to spike. After decades of decline, it began spiking in the late 1970s, early 1980s. And that was just the moment when the U.S. retirement infrastructure began to change from a pension-based system to a defined contribution system. And what does that mean? Well, that means that now the onus was on us, the individual, to save, put dollars away for retirement, and it was on not our employer. And it was also up to us to be, really selective and to make sure that we're picking the appropriate investments that, that would provide us with yield and with growth. So we'll talk a little bit more about that in a second. But there's just so much injustice in our capital markets. I mean, look at this. These are charts that show the number of years it took these various stocks to reach 50 billion in market capitalization. And what you could see is that today, most company value creation occurs when the company is private, not public. So, what's happening now is that individuals were becoming really more of the exit strategy for the financially privileged. And that's just not the way it should be. Nothing says it more than, Uber. I mean, these are just staggering facts that, that you could read. But basically, Uber is valued at a 50-somewhat billion dollar valuation today. Already had about $8 billion invested into Uber. It's all institutional capital. There's not one Uber share that's appreciating in a small retail, investor's retirement portfolio, not one. And this is not an anomaly. Companies today create value faster than far ever before. That's what technology is enabling us to do. But unfortunately, they're creating value for those investors who the government deems worthy enough to access growth. And our credit markets are just as flawed and unjust as our equity markets. Conventional fixed income assets can barely outpace inflation anymore. And, while those fortunate enough to invest in private credit opportunities, they're in some cases reaping double-digit returns, where, everybody else is basically, paying the bank to hold their money. And that's why you have qualified investors, and this has been going on for a while, flocking to alternatives. And, it's not hard to see why. In many cases, it could provide greater yield and less volatility. These are two great charts that compare the Barclays U.S. Aggregate Bond Index, the High Yield Index, and Direct Lending Income Fund, which is a fund that invests in that invests in platforms that provide small business loans online. Now, this is a great chart. Okay, I came across this chart the other day from McKinsey, and they're basically saying how, we're not going to see the same type of investment returns in our equity and debt markets in the next 20 years, the ones that we've experienced previously. And they're warning investors that you need to temper your expectations. And I thought to myself, that's their solution? You just have to get used to it? I mean, well, what kind of solution is that? It's kind of the dumbest thing I ever heard. It's like going to a restaurant and ordering the salmon, and the waiter says, "Oh, no, I'm sorry, we don't have salmon. You'll just have to sit there and watch everybody else at the table eat." I mean, that just doesn't even make sense. He doesn't say that. He says, "No, have the mahi-mahi." It's superb. Then Jim and I were working on a new white paper about that's going to be focused on retirement and providing a solution for the retirement crisis, and came across this chart. Staggering. The retirement assets of 100 CEOs is equivalent to the retirement assets of 41% of American families. It's unbelievable. And, and you'll soon see as Jim gets into his presentation, we are facing a retirement crisis of unimaginable proportions. And yet, what are the experts saying? Our greatest economic minds saying as a solution? They're saying, oh, you just need to save more money. Get used to it, save more money. I mean, this is just, tough noogies is not a solution. You know, tough noogies is what I tell my kids when they won't eat my salmon for dinner. So what is the solution? The solution is democratizing access to deferred alternative to tax-deferred alternative investing. This is where the solution lies, and it is also coincidentally the catalyst that's going to enable crowd finance to scale. There are three things happening right now in Confluence that's really going to enable this industry to scale. First, the legislative winds are shifting in the direction of the retail investor. There's been an incredible amount of financial ingenuity that are happening on the product side, these new products that are emerging. We call them crowd-centric retail alternative products for retail investors, for the masses. And then, what's happening in the fintech space, new technologies, resources, tools that are making tax-deferred micro-alternative investing both simple and affordable. So this is what's been kind of happening the last couple of years, right? The investment products were emerging, the tools were emerging, the platforms. And now, finally, we have a modern retirement vehicle for a new fintech-driven industry. And this is going to be the catalyst that's going to allow crowd finance to scale. Now, having the products are great, but we need the people to actually invest in them. We need distribution. And most Americans do not invest with cash that they have sitting around in their savings or checking accounts. They use their retirement dollars. So you need to have the process both simple and affordable to use your retirement dollars to make investments in alternatives. And until now, that just wasn't available. Until a company called IRA Services spent the last 3 years and $10 million developing a new technology called ISCP, it's a game changer for the industry. And Jim is going to talk more in detail about it and show also how crowd finance platforms can integrate this technology, the ISCP technology, to scale. My goal here was really to provide the big picture of all of this. But I will say this, the scalability of all crowd finance platforms are ultimately going to depend upon their ability to penetrate that $14 trillion retirement market. And that's going to require the right technology, it's going to require the right partnerships, and it's going to require a lot of education and tools. But you know what? This is really, none of this is anything new, okay? This is simply history repeating. It happened before in the 1980s when an emerging product you may have heard of called the mutual fund, met with and married a new retirement vehicle called the 401k and the IRA. And together, they were able to blossom into multi-trillion-dollar industries. Now, we finally have now the same thing happening here. We have I believe with the ISCP technology creating the modern self-directed IRA, it could do for crowd finance today exactly what the IRA and the 401k had done for mutual funds 30 plus years ago. Allow this emerging asset class to balloon into a multi-trillion-dollar industry. Now, I'm not just saying this, I'm not guessing, I'm not predicting. I am telling you this is going to happen, okay? You go back, read some of my previous predictions. I've been pretty much right on the money for the last couple of years with where this industry is going. And it's not because I'm clairvoyant, well, maybe a little, but it's not because I'm clairvoyant, and it's not because I have a flux capacitor, okay? It's because I know that the best way to predict the future is to create it. And that's what we're all doing here today. We're all in this room creating the future. We're all going to make it happen. So with that, I'd like to introduce you Jim Jones. Most of you don't know, but Jim Jones has been doing more for this industry behind the scenes than anybody realizes. He is developing the distribution channels and the solutions that will allow crowd finance to scale and not be some shadow of a financial services industry, but rather the financial services industry of the future. And with that, my honor to introduce Jim.
Dara, thank you very much. That's great. How are we doing for time? Sitting here? Okay, all right. I always seem to be the one standing between either lunch or cocktails. So I will move this along. All right, so let's just take a quick look at the size and opportunity of the retirement market, the current problems that exist, and now the future, which will be the solutions. So I'll break out, but approximately in the United States, the retirement market is a $14 trillion market. There are over 50 million individual retirement accounts. Here's something for those that are going after accredited investors. If you take household incomes of $200,000 or greater, they make up 80% of the value of IRAs. Less than 1% are investing through self-directed IRAs, and there's a reason for that. We'll get to it. And then this is really will be the staggering number. More than 99% then of crowdfunding made up of equity, peer-to-peer, and real estate crowdfunding are doing so in tax-efficient, taxable cash accounts. There we go. Okay, so just a quick breakdown. This last year was a pivotal moment. For the first time in history, the individual retirement market outsized the defined contribution market, or 401k. It's now 7.6 for IRAs versus 6.8, and there's a very important reason for that. It's the retiring baby boomers of 10,000 a day are rolling over their 401ks into IRAs. Last year, $450 billion came into the market for IRAs looking for a place to invest, at the top of the equity market, at the bottom of the fixed income market. I think this is probably the most astounding number. For every $1 in personal checkings and savings, and I mean investment accounts, not money that's targeted for mortgages or groceries, but investable dollars, there's $12 in retirement accounts. All right, so I think we've got it upside down in this industry. Again, we're all chasing 99% of tax and efficient taxable cash accounts, and nobody is really going after the retirement market. That's 12 times the size. But there's a reason for that. The problem, obviously, again, there's a need for self-directed IRAs in this world of private equity and private debt, because the custodians, like E-Trade and Schwab and Merrill Lynch and Morgan Stanley, will only custody publicly traded assets, stocks, bonds, mutual funds, and ETFs. So, number one is the problem. The problem is the process. The underlying software that drives the self-directed IRA custodians is built on banking software that's 40 years old. The second, there's a three-step process of opening the account, funding the account, and then directing the investment. That is all done manually. The average time is 4, 6, 8 weeks to accomplish this. There's no integration. There's no API between the custodian and the platforms. So that means right now the customer has to go to the platform, sign up, leave that platform, empty shopping cart, right? And then they have to open up a second account 4, 6, 8 weeks later, and then they have to try and get the two talking to each other, which they don't like to do. The second is pricing. So self-directed IRA custodians are non-fiduciary trust companies under state banking charter. That means that they don't take a piece of the transaction. So their business model is based on annual fees. Okay, $50 to open the account, $200, $300, $400, $500 per asset per year, and then transaction fees of $100. So you're looking at normally around $2,000 or more to do that. With Title III coming, with real estate crowdfunding starting at $500 to $1,000, it just doesn't work economically. Promotion is probably one of the most overpromised, under-delivered. There's a few platforms out there saying, hey, we'll put your logo on our platform and we can market to our 50, 60, 70,000 clients. And I caution you, you don't want to do that. That's a prohibited transaction under IRS Code 4975. They're giving preferential pricing, so they're indirectly benefiting. A self-directed IRA custodian is a prohibited partner to the platforms. So I don't think any of the platforms want to draw the scrutiny of the IRS. What you need is a third party to do that. And then lastly, this is where the industry will really scale and why it hasn't to date is the assets under management. So if you're with an RIA or an independent advisor and you want to make an investment into one of these assets, you need to leave that firm and you need to move those assets under management to a self-directed IRA custodian. And so to date, it's not really being done. So what's needed is a technology solution that will allow the assets to be held away at that broker-dealer. What's out there currently? So there are a few firms that say, well, you know, we've automated the system. And so if you go to some of the platforms, they have a landing page. And a landing page is not fintech. A landing page is where you enter name, address, social, beneficiaries. That data is captured by the platform. And then you have to turn around. One of the biggest platforms says, I love this, complete the application online and then print out the 60 pages and mail it. And that's truly what's happening. So you have to mail those documents to the platform, who reviews them, who then mails them to the self-directed IRA custodian. Okay, so it's still based upon the underlying 40-year-old legacy IT systems. All right, so that is the problem then that needs to be solved if you could hold those assets away at a broker-dealer. And again, I'll move pretty quickly on this. I don't want this to be or become a commercial, but essentially IRA Services has founded the solution by offering a cloud-based, API-driven, white-label platform that will sit and reside right on the platform. And then all of the client data is transmitted via API right to the custodian, who behind the scenes completes the three-part transaction. Scalable, 250,000 accounts per hour can be opened, and for the first time, you don't have to have a separate retirement account with a self-directed IRA custodian and then your retirement account assets over here. You can hold all of your stocks, bonds, mutual funds, ETFs, and then crowdfunding, real estate, or peer-to-peer market in one retirement account. And then a great quote, I think, from Peter Hinson: organizations need to become networks themselves. It's the only way they'll be able to equal the speed of the complex adaptive systems that the market have become. And we've been told, 3 years ago, I started the effort of a landing page, signed on the top 50 equity, real estate, and peer-to-peer crowdfunding platforms, and every one of them was a miserable failure. It didn't work. We did the landing page, but the rest of it was manual, didn't work. And as I like to say, in the peer-to-peer side, a good friend Ron Suber of Prosper said, you know, until your industry can automate and integrate, retirement accounts will be an accommodation at best. And then he went on to qualify and say, but we believe 50% of our business, at least, should be retirement accounts. So, thank you.
Oh, sure.
Okay, sure. Right. So a crowdfund platform will connect through your software to deal with your database of customers at IRA Services.
So that's a great question. So again, there is a Chinese wall, if you will, between the clients of the self-directed IRA custodians and the platform. So the platform still has to market, but when they market now to retirement accounts, they have an automated solution that will help the process.
Okay, to qualify what you're saying, all retirement accounts or only IRA Services?
To all retirement accounts.
Okay,
Yeah.
Does this in any way speed up the, let's say the IRAs at Fidelity? Does it speed up the amount of time that the money from Fidelity comes in so that me, the syndicator, can get the money real fast?
Yes, it's automated up front. It's captured at the platform, but we use the ACH to just wire it right over rather than wait for that manual.
Yeah, but what about Fidelity sending the money to you? Does that process get sped up?
Yes.
It does.
Yes. Yeah. And that usually was the biggest snag because it was paper driven. It was wet signatures. It was medallion stamps. It was up to the resigning custodian, and then if they forgot a date or a medallion stamp. So we've automated all of that.
Fidelity does not do self-directed in real estate.
That's correct. So, you know, the Fidelities, the Schwabs, after Dodd-Frank, they used to partner with self-directed IRA custodians to accommodate high net worth clients, and since then, They won't touch it. They'll lose the assets under management. They have a list of 4 or 5 custodians that they say, go open up the account, you're on your own.
So, how do I sign up? I mean, how can I do this as an investor?
So as a retail investor, if you are going to work with one of the platforms, we're in discussions and signing up almost all the platforms right now.
So I sign up with you through the platform as opposed to coming to your website?
You just right on the platform. When you're opening up, let's say a Prosper IRA, you'll be going there, and you won't even know that this is the technology that's powering it.
It just
So
says
we just-
invest now, and you enter your information, processed. No leaving, no opening up a second account, no back and forth.
Quick question. You just recently did a report about this particular.
Yes.
When somebody wants to, the audience, where are they going to go? Which website they go and get this report?
Sure, and it's actually on the papers there. It has a little QR code that you could click on to get it, but you could also just go to daraalbright.com. It's all splashed on my homepage there, and you can link right to it, download it. It's free.
What's the name of the report?
It's a long name. The Renaissance of the Retail Investor, and oh God, I can't even remember the whole title. It's on
It's in daraalbright.com.
.com. Yeah.
Thank you. Any other question?
So if I was an investor and I want to be able to access the other funds, but want to keep them separate, like how does it appear in that account? Is it as in like, are they all considered a part of one pool, or do I keep the different money separate on that platform? How does that work?
You have a choice. So you can either move money over strictly for investments in that, or you can do what's called in-asset transfer or in-kind transfer, where you can bring everything over, where you can see everything. It's your choice. You no longer have the restriction, though, that they are separate. You can bring them together if you'd like.
Well, thank you, Dara. Thank you,
Thanks.
Jim.
Thank you.
Appreciate it. Thanks, audience. We're going to take a break for lunch.